So chapter 11.1, I'm going to be introducing you to what depreciation is, okay? So what is depreciation? It's when fixed assets, right? When we purchase our assets. And the one thing that we notice is that we have the guidelines and rules of the historical cost, right? Acct says that when we purchase our assets, it stays that value. But in reality, right, if we're using our assets, right, and or if we decide to return the asset as after we've opened the box, right, can we actually claim that the what we purchased it for the price value of is going to stay the value if we actually use the machine? In this context, no. It cannot reflect or hold its value, especially if you open up the box and you use the machine. Now that's a huge factor, and that's exactly what we're going to be talking about today is, well, what happens when we use our assets and how do we adjust its price value to reflect how much it is worth now that I have used it. So the idea here is that when we purchase our fixed assets, our assumption is that it does not retain its value over time, especially when you're using it for your business, okay? So when we realize this, right, if we buy furniture, we sit on it, and we try to sell it out, you can't expect it to hold its value for what you originally purchased it for. Unfortunately, it's significantly lower, okay? Especially when you purchase cars, right? What do they tell you when you drive off the parking lot? Your car is automatically depreciated the minute you drive off the parking lot. So therefore, if you do return it, you're not going to get for the amount that you paid for. It's going to be significantly less. So the idea here is that when we're looking at depreciation, we're looking at how long does an asset last for, right? So as we know, machinery, especially machinery, has a time on it, right? You can't expect that a machine or a toy or anything that's electronic to last forever, right? At some given point in its time, it starts to wear and tear, right? The rubbers don't fit on the machine properly anymore, right? Everything that you need to oil it up, or you need to take it into maintenance. And that's where that means every fixed asset that you have or you purchase will have two factors, right? It will have a price value, obviously. And second thing it should have is some kind of estimated useful life, okay? And when we determine that, what we're going to do is we're going to spread out the expense, or we're going to spread out how much that asset cost us and expense it out throughout its entire life, okay? Now let's keep in mind here, this is depreciation and it's strictly only for fixed assets, okay? So let's go ahead and talk about the components that we're going to be needing in order to calculate depreciation, okay? Sorry, that's the slide after. This one here, so what is depreciation? Once again, it's a way for a company to spread the cost of its life and expense it or use it as a representation of us using the machine and devaluing or getting our book value in case we do want to turn around and sell out the product, okay? But it also allows us to kind of adjust our assets, because when you purchase the asset, right, and we have the assumption that our assets are not going to hold its value over time, we need some kind of way to represent and to journalize it, and that's what depreciation is. So once again, I've mentioned here, right? perfect examples would be any electronics, right? Computers, printers, furniture, trucks, okay? Those are all going to be considered fixed assets, right? Things that we buy to use in the company, all right? And here's one thing that you need to know. Land is considered a fixed asset. Yes, it is. However, in this context, when we're learning financial accounting 101, you will learn that land can never be depreciated, right? Think of it as in terms of reality, right? Can you depreciate land? Can a land lose value over time? In fact, it actually gains value over time, right? If we're looking at real estate or property management, in terminology terms, right? In reality terms, land actually appreciates over time. It gains value. But in context of accounting, we never increase value over time because the assumption is that you can't add invisible money to property. All right? So in this context, you cannot depreciate land. As we go to advanced level of accounting, you will learn that land can be depleted, right? Because, for example, land, there's value to the land because it could be an oil mine. It could be land that has special minerals underneath it. It could be a diamond mine. It could have value, right? But if we remove those resources out from the land, therefore you're depleting the land, all right? And once again, I'm just educating you now so you don't walk out in the real world and just say, hey, land can never be depreciated. I'm telling you now, it's not depreciate, it's depleting, all right? Different terminology for different types of contexts, okay? But for this, fixed asset will be depreciated, land will be depleted, okay? Okay, land will never be depreciated, it will be depleted. So now we can go ahead and talk about what are the contributing factors or what gives us the reason why we must use depreciation, okay? And the number one is going to be GAAP, all right? As we mentioned before, right? Historical cost is going to be one of the contributing factors of depreciation, right? Because in this case, this principle tells us, hey, you cannot add or subtract any value to an asset, right? The day that you purchase it is going to be the day that you're recording it in your books. You're recording it at historical cost. So therefore, in the future, your assets cannot gain anything, right? That's the idea here for GAAP. So whatever you purchased it for is whatever it's going to stay its value. Now, this only holds its truth until the day you sell your asset. So if you purchase it and you plan on selling it, then yes, then you can recognize, did you sell it for more than what you purchased it for? Then yes, then you can recognize that you gain money and that you gain extra money on top of what it originally cost you. But in this context, right, we're assuming that when we purchase our fixed asset, we're assuming that we are going to keep it and use it until its life is completely over. So in this context, we have no means to sell our fixed assets. So therefore, we must record at historical cost. Okay? Second thing is going to be matching principle. Now, for whatever amount that we used to purchase it, right, whatever amount that we purchased it from is going to reflect the total amount that you're going to depreciate it for. okay? So in this case, right, if my asset is $10,000, then therefore, when I spread my cost amongst it to represent that I'm using the machine, it should equal to $10,000. No more, no less. Okay, so that's what matching principle does. It matches your income with your expenses. So in this case, because I use the machine to produce the items to create my inventory for me to sell my products, therefore I should expense my use of the machine as my means as a cost to spread out for my cost of goods sold. Okay, so therefore we're using the matching principle. Okay. So now let's talk about how we're going to recognize depreciation and how we're going to calculate depreciation, okay? You're going to be needing 5 components. First component is going to be the cost of the asset, okay? Then the second thing is going to be your estimated useful life. Third is going to be whether you have a salvage or residual value. Fourth is going to be the date that you place into service. And fifth is going to be which depreciation method you will be using to calculate your depreciation. Okay? So let's break it down to each and every single one. First thing is going to be cost of the actual asset, right? So in this case, the definition or what you have to actually consider as part of the cost of your fixed asset is going to be every single cost it takes you to get your fixed asset ready for service. Okay? Not to the store, but to get it ready into service. Okay? So those costs will definitely include number 1, your original price that you purchased it for, right? How much did it cost you to purchase it from the store? Tax will always be charged here because you're buying stuff from a store. So you will be taxed. Okay? Third thing is, if it's a machinery or equipment that needs to be shipped to your store, you're going to have to pay for that too. Okay? And any additional features, fixtures, or things that you need to add. So for example, you need to add an electrical unit. That's going to be cost to get your asset ready for service. Okay? Other things could be any product fees. Maybe you bought a computer, but you need a subscription to QuickBooks. That's going to be considered a part of your fixed asset because that is something that your computer cannot do alone. You're using it for one thing, and that's to use QuickBooks. And if that's the case, then you need to add the subscription to the fixed asset because that computer is just there. You're not using it for anything other than using it for QuickBooks. So therefore, that's going to be something that you need to tack on to get it ready for service, okay? Other things could be any training, okay? Training is going to be included because if they don't know how to use the equipment, you definitely don't want them to file a lawsuit against you for injury. You need to properly train them. So that's going to be considered something that could be part of the fixed asset itself. Any maintenance, any repairs, any installation, that is going to be considered something that is going to be part of the fixed asset to get it ready for service. Okay? So this one's a little more complex. You need to make sure that you understand what are the total costs that are going to be included to the fixed asset to get it ready for service. Okay? Then we're going to talk about section 2 and section 3, which is determining the estimated useful life and also determining the salvage value. Now, there are 2 ways that we're going to be taking a look at this, right? GAAP controls a lot of what many major businesses do. So with gap, all right, gap in the IRS, if you are a big company, an LLC, a corporation, you are mandated to follow the rules and guidelines from GAAP and to follow what the IRS tells you. Okay? And what they tell you is that all fixed assets has a preset number of estimated useful life. So in this context, right, they have a similar to a Blue Kelly book, right? So Blue Kelly book tells you what the value of a car could be, depending on what model, depending on what it is, right? Same thing here. The IRS has a book that tells you exactly what each item or each fixed asset holds some kind of estimated useful life. Okay, so most common are going to be electronics, right? They typically have a 5-year lifespan, right? Now, of course, nowadays, with newer technology, right, a laptop could easily last you longer than 5 years. But that also depends on how often you use it, right? And of course, if it's a furniture or like vehicles or anything like that, that will typically have a lifespan of 7 years, okay? And you will also learn as you go advanced level of accounting, buildings can be 9 or 11 years, okay? And that's what the IRS and that's what the GAAP tells you, that you guys already have a set number of estimated useful life, okay? Now, that's what corporations and bigger businesses have for you, okay? But for us, for sole proprietors or for smaller companies like a partnership, you guys have a little more flexibility. And once again, you can create what your estimated useful life is. Because again, a corporation, they're going to be mass producing. They're going to keep their machines on 24/7 and keep running throughout their business. Where if you're a smaller business, you buy a printer, you might only need to print 1 sheet per day. You might only maybe even print on only 5 out of the 7 days. You're not running the machine on 24 hours a day. So with this idea, right, management can go ahead and determine what the estimated useful life is. So I can say I bought a printer. Realistically, I only print maybe 100 pages a month. So therefore, I'm going to say my printer can easily last me for 10 years before its rubbers, its wheels, its mechanics start breaking down. Because I know I'm not going to be frequently using it. I'm not going to have it on 24 hours a day. So therefore, in this context, we can create whatever the estimated useful life is, right? But of course, given in context, right, that is going to be looked by IRS, right? You can't be using a crazy number saying, this is going to last me 25 years. Realistically, no. You do need to do your research on there, okay? And you're going to be determining based on how frequently you use it, okay? If it's something that's going to be not run 24 hours a day, then yes, you can safely do your research and say, well, if you actually did not know this, on every single manufacturing box, it actually tells you the estimated useful life. So a lot of printers, right, or a lot of electronics or a lot of equipment that has machinery involved, they always have a warranty. Why do they always give you a warranty? Because always, no matter how often you use it, right, it will break down. And the warranty is supposed to kind of prevent that, give you the fixtures that you need, whatever you need, right? So that's the same idea. So if the manufacturing box has a warranty on it, it also tells you how long or how much a machine can either produce or how long it should last you. So a typical printer, right, will tell you right on the box that it should print up at least 100,000 up to 100,000 pages before you need to do a maintenance. Okay? So the research is pretty much done for you already. All you have to do is just consider, well, what makes it easier for you? Okay? And the easiest thing to do is go to the Blue Kelly book that the IRS does, because that way you don't need to do your intensive research, okay? All right? So that's what we can do compared to someone who's a corporate and that has to follow the rules of GAAP and the IRS, okay? Now, of course, with the GAAP and IRS, they will tell you this, that when you purchase a fixed asset, so as a corporation, right? If you purchase a fixed asset, therefore, at the end of its useful life, it will not retain any dollar value. Okay? Why? Because major corporations, if they're making so much money and they're constantly using their fixed assets 24/7, then you can assume that that asset is being run down to the ground. It shouldn't hold any value at the end of its life because of how much you're using it. Same idea applies to sole proprietors or partnerships, smaller businesses, right? But in this context, right, you can have a salvage value, all right? And I'm going to give you an example right now, right? If a corporation decides to buy a truck, right? Now they can drive that truck anywhere, right? Because as a corporation, that truck could be driven across many states. It could be used 7 days a week to ship out items left and right. Okay? So the assumption here is that under GAAP and IRS, they will deplete it to they will depreciate it to the ground. So therefore, it should hold no value at the end of its life. So no salvage value when it's under IRS and GAAP rules. But as a sole proprietor, you buy yourself a truck. Maybe you drive it 3 times a week. You're only doing small deliveries. You're just driving down to the end of the corner of the street. How in the world, by the end of its life, will it not have a salvage value? And in this context, it should. Why? Because you're a sole proprietor. You're not using it as much as a corporation would. You're not running it to the ground. You're just using it to determine how much. So in this case, you should have a salvage value, or it should have a value at the end of its life. So in this case, right, the truck, you bought a $30,000 truck. At the end of its life, let's say it's 7 years pass by, you can guarantee your truck should be worth at least a minimum of $5,000. And you can claim that in your books as a sole proprietor. All right? If you're anything other, a big corporation, big company, LLC, you cannot claim that your truck will be worth something at the end of its life. Okay? Any questions here?
No.
Okay. Okay. So then, now we're going to be taking a look at the date of when you placed into service. This is very important because this pretty much allows you to take your estimated useful life and use it for its entire life, right? So when we purchase our fixed assets, we got to treat them like they're babies, right? You are 1 year old from the day that you were born. You're not 1 year old because the year turned, it's a new year. Does that make sense? So in this case, when we purchase our fixed asset and it has an estimated useful life, we need to determine when you place into service, because that's going to be the day that you start depreciating your asset. Okay? So because we're treating it like if it's our babies, right? If you place it in service as of October 1st, then every single month after that, or any year after that, when it rolls around the next year to October 1st, that is considered you using 1 year of its life. Okay? Now, in context, right, we are pretty vague about our depreciation, right? You have kind of ways that you can go around it. You can depreciate every day if you'd like. That would be a little excessive. But most cases, right, you would normally depreciate either at the end of every month or you would depreciate at the end of its year. Okay? At the end of the year. Okay? And how we fall in this rule is that if you place it into service between the first 15 days, that means you used it for more than 50% of the month. So therefore, when you start depreciating it, you're going to include the month that you started depreciating it. Okay? However, let's say I decided to depreciate it on any day after the 15th. So let's say I depreciate it anywhere between the 16th or the 30th or 31st of the month. That tells me I barely touched my machine 50% of the time in this month. So therefore, I don't consider myself depreciating it. I'm going to depreciate it the following month because, well, let's say I put the machine of it ready for June 28th. Why would I lose or depreciate it a part of its life if I barely used it? So that's the same idea here. I barely used it 50% of the month. So therefore, if I only used it 2 days out of the month, I'm just going to go ahead and just treat it as if it's going to start on the very following month. Okay? So that's how we understand the date that you place into service. And because we're treating it as if it's our baby, right? The day that you place into service is going to be the day that you start its life. Okay? All right. Any questions here?
No.
Okay. All right. So this is going to be very crucial that you pay attention to this because there are times, right? Like I've mentioned before, you have a couple choices, right? You can either choose to depreciate the end of the month, or you could choose to depreciate at the end of the accounting year. All right. So therefore, paying attention to this is very crucial. Okay, because we will deal with partial years. All right. Then the fourth one, the last but not least, is going to be what type of depreciation method you are going to be using to calculate your depreciation. So for this class, if you go into your books and into the reading, there are infinite amount of depreciations, right? You can use, for example, you can use activity-based, you can use straight line, you can use some of the years, you can use a mix between them, a special one, all right, a hybrid of these depreciation methods. There are a lot of depreciation methods out there, but the most common one, and the one that's approved by the IRS, is going to be straight line and double declining. Okay? Now, how do these two work? Well, let's talk about each and every single one. Activity-based, right? So in this class, we're only going to be taking a look at 3 different types of depreciation methods. Okay? You're going to be taking a look at activity-based, which is also known as units of production. All right? This word is interchangeable between both rounds, right? If you're going to corporate, they might refer it to activity-based. They might, if you go to LLC, they might refer it to units of production. They're the same thing. Straight line is universal, right? You're moving in a straight line. And then the third one we're going to do is going to be accelerated, or also known as double declining method. Now, each method is going to be based on how you use your machine, okay? So the very first and the one that we're going to take a look at is called units of production. Units of production is going to be based on its capacity of how much a machine can produce, okay? Hence, units of production, okay? Straight line, which we'll talk about tomorrow. I'm sorry, not tomorrow. This is going to be Thursday. Is going to be based on where you're going to spread the cost evenly amongst its useful life. So if it's got 5 years, what you're going to do is you're just going to take the cost of it and you're going to divide it into 5 and call it a day. And that's why it is most popular for IRS, because it's the easiest one to calculate, but it's also the easiest one to recognize. Okay? Double declining is the same, is what we're going to learn tomorrow, is similar to straight line, but the idea here is that when we double decline it, we're double depreciating it. So think about all of the electronics that when you buy it for the first time, right, you start using it so much in the beginning of its life, but as it gets slowly, as time passes, the machine, the operating machine starts to get slower, and you start to use it less because you get frustrated with it. So that's the idea for this, for double declining, all right? And these 3 ones are going to be the most common ones you will see in most businesses, okay? The other ones, not so much, all right? So once again, we're going to take a look at the very first one, which is activity-based method, or also known as units of production. Okay? Now, these are the formulas that you will need to know to calculate the units of production depreciation method. Okay? So once again, when we're looking at this, we're looking at a capacity that a machine can go up to. Okay? So a good example would be a printer. If a printer has a capacity of it being able to print up to 100,000 pages, that's your capacity. If it goes beyond that, the machine will break. So same thing with a truck, right? A truck would most likely be depreciated based on the number of miles you use your truck, right? What is the capacity now? 150,000 miles before it needs to get an oil change? Before the wheels start to wear and tear? So that's the idea here, is we are basing it off of how much a machine can be used for, all right? So in this context, right, we're going to be taking a look at 5 formulas. First formula is going to be your depreciation basis, which is going to be your total cost of the asset minus any salvage value, okay? Because that's going to give us how much I can depreciate the asset up to. Because if it can hold value at the end of its life, you want to subtract that out from your original cost, because you're saying at the end of its life, it should reflect your salvage value. So that's depreciation basis. You're going to calculate how much you can depreciate up to. All right? Now the next one's going to be called a per unit rate. The per unit rate is going to be taking how much you can depreciate your asset till, right? And you're going to divide it by the total number of units that the machine can produce. So this is where your capacity is going to be placed right here. Okay? Okay, so your capacity, if it can produce 10,000 units, that means what you're doing here is how much is it going to cost me per unit to depreciate. Okay? So you're finding a per unit rate to calculate how much is it going to cost you to produce one item. Okay? And then depreciation expense is going to be your depreciation rate, or in this case, my per unit rate, and you're going to multiply that by the total number of units produced that year. Okay? Not the capacity. How much did you produce that year times the per unit rate? All right? And that's going to give you depreciation expense. And then as we get our depreciation expense, we're going to calculate our accumulated depreciation, which is going to be your previous years of depreciation, of accumulated depreciation, plus your current year's depreciation expense. Okay? And then last but not least, you're going to determine the book value.
Wait. So you're only going to compare it with one previous year?
When we
Previous
when
year
we look at the
accumulation?
when we look at the chart, you'll see where this formula is coming to play, because the previous year, okay, if it has 5 years that you can depreciate it up to, you're taking the previous years. So if I'm on year 5, I need to take years 4's accumulated depreciation plus year 5's depreciation expense to get my total accumulated depreciation. So what you're essentially doing is you're just adding the depreciation bases together, or depreciation expenses together, to get you a grand total of how much you're depreciating. All right? You need this number in order to solve for your book value. Okay? Because your book value is going to be your total cost of the asset minus your accumulated depreciation. So in this case, right, if I'm accumulating my depreciation, if every year I am depreciating $5,000, right, every year it's going to accumulate, right? If I'm doing 5,000 this year, 5,000 the next year, therefore I have a total of 10,000 right now. So therefore, my cost of my asset is going to be $10,000 less, because that's how much it's going to be worth now on my second year. All right? So
So that will be subtracted.
yes.
So okay. All
So
right.
let's go ahead and go through the example, so then it makes sense as we go through each one, okay? So first here you have an example, okay? So as I mentioned, you need 5 components, okay? So here example says that record the depreciation for the first year, okay? And here is your information. Number 1 is the depreciation method, which we know is going to be the units of production, okay? Second thing is, what did I buy? I bought a machine. How much did the machine cost me? It cost me $15,000. There's point A. What is the asset cost? $15,000. Next thing is, what is my salvage value? So because I am a sole proprietor, I say this machine should, at the end of its life, be worth $2,500. All right, this is a $15,000 machine. It should, at the end of its life, be worth $2,500. Its estimated useful life is 5 years. Its total amount of units that it could produce, so my capacity, is 10,000 units. Okay, and the date that I place into service is January 1st. Okay. Now in this case, right, I said my first year of having the machine, I produced a total of 2,100 units. All right, so this is the given scenario, this is the given context. So now we're going to have a table that looks just like this. You're going to figure out what the rate is, what the basis is, what the expense is, and what is my book value. Okay? So let's start with the very first one. Okay? First one is determining what my depreciation basis is going to be for my first year. So in this case, right, it's going to be my asset cost minus my salvage value. So in this case, what's my asset cost and what's my salvage value?
15,000 minus 250.
Good.
2,500.
Good. So therefore, my depreciation basis should be
12,500.
12,500. Correct. So this is what I can depreciate my asset for. This total amount right here is 12,500. That's how much I can depreciate it for. Okay. Now let's take a look at the second one, which is finding out what the rate is. So in this case, right, we need to solve for the per unit rate. How much is it going to cost me to produce one item? Okay. So in this case, I'm going to take my depreciation basis of 12,500. I'm going to divide it amongst its total amount that it can produce overall. So in this case, right, how much can my machine actually produce altogether?
10, 10,000, it would be 10,000 times 5.
No, where are you getting 5?
The useful life of 5 years.
What's the formula to
No,
solve for the per unit rate?
the 12,500 multiplied by.
Where do you see multiply?
Oh, you said what's the formula? It'd be right here. Minus, so it'd be the 15,000 minus the 2,500. I don't know. I'm lost. I am so lost.
My question to you is, how do I solve for my per unit rate? What's the formula? The formula is right here on the screen. I'm solving for my rate right now.
So you would divide the depreciation basis by the total estimate number of units.
Correct.
So the depreciation value is 12,500
Good.
divided by by the units,
How? Which one?
the 2,100, the unit produced
That's produced that year.
that year.
In this case, am I looking at that? I need to solve for my total numbers that the machine can produce in general. So what's my total capacity here?
10,000 units.
10,000 units. So in this case, it should give you $1.25 per unit that I produce. Okay? Because I'm going to take my depreciation basis of 12,500. I'm going to divide it by my total capacity of 10,000 units to give me $1.25 per item I produce. Okay?
Okay, I got it.
So in this case, how do I solve for my depreciation expense?
That would be, since it produced for the year 2,100 units, wouldn't it be 21 times 1.25?
Correct. 2,100 divided times by 1.25. And what is that?
Where's the 21?
You see where it says
Total units per year.
units produced that year?
Is it 26,
All
20?
right.
Okay, so the 2,100 is what I produced that year. Okay, and yeah, it should be, yes, 26.25. Okay. Now, the next step is I need to solve for my accumulated depreciation, which is my previous years plus my current years of depreciation expense. So did I have a previous years for accumulated depreciation?
No.
So that's automatic 0. And I need to add my current depreciation expense, which is
2,625.
Correct. Because I don't have a previous years. This is my first year, so automatic assumption is it should just be the same. So now I need to show in my books how much the value of my asset is after I used it and produced 2,100 units. So in this case, right, my book value is going to be my cost of my asset minus my accumulated depreciation. So how much is that going to be? 12,375. So that is what my books look like, all right, for this machine because I used it for one whole year to produce a 2,100. So therefore, my book value, if I want to return or if I want to go out and sell it out and purchase a new machine and sell this one, my baseline should be that should be worth $12,500. 12,375. Excuse me. Okay? Because if I decided to sell it now, that's my baseline because I've already used the machine. Okay? Everyone good? Okay. So let's go ahead and do the second year. Okay? If the second year I decided to produce 2,000 units, what should be my depreciation basis, rate, expense, and so on and so forth? So let's take it one at a time. So first things first. What is going to be my depreciation basis?
The same number?
It is correct. Same number, okay? What's my per unit rate? Okay. What's my per unit rate?
The 125?
125. Okay. And therefore, what's my depreciation expense going to be for the second year?
$2,500.
2,500. Okay. So that's exactly what's going to happen for the second year. This time, what you're noticing is you're noticing a trend. Okay? My depreciation basis, it seems to be the same every year. My rate is also going to be the same every year. The only difference here is my expense is going to be different. Okay? And as you can notice this here, let's calculate what my accumulated depreciation is, right? If I've already depreciated $2,625, right? And now I have to depreciate an additional $2,500, my total amount of accumulated depreciation is going to be $5,125. Okay? So this is accumulated depreciation, right? You're just adding your total expenses together. Okay? To get so far for year 2, I've depreciated a total of $5,125. Therefore, my book value, right, is going to reflect that it should be now worth $9,875. Okay? And so once again, what you're going to notice is that if you actually calculated all of this, it should equal to your capacity of 10,000 units. You're going to notice that your depreciation basis and your depreciation rate are the same. The only difference that you're doing is you're just calculating your depreciation expense differently because, again, it depends on what the amount that you produce that year, right? This number here, the units that you're going to produce that year is going to always fluctuate. Okay? And again, what you're going to notice at the end of this 5th year, your accumulated depreciation should match your depreciation basis of 12,500. Because watch this, your book value at the end of its useful life will reflect your salvage value, right? You said that your salvage value is 2,500, and there it is, 2,500. Okay? Any questions so far for this depreciation method?
What if the salvage value that you said it was going to be is not the same? You just adjust.
Correct. Correct. And that's actually the next section right here, right? Now, let's just say potentially, what if on year 5, your machine actually produced a total of 2,200 units? Okay? So go ahead and do the calculations. What's going to be your depreciation expense for that year, your accumulated depreciation, and of course, what's your book value going to be? Okay? Right, in context, if you were to solve for it, you would end up your book value being 2,250. Okay? Now, because in this case, right, you push your machine past its capacity, right? So therefore, there's a lot of potential of those items being defective, right? Because at the end of its life, its machine, right, it's slowly wearing and tearing. Maybe it's not producing fast enough, etc., etc. If you go beyond its capacity, then here, for this example here, it's going to show that this is how much you have it. But when we calculate this, your salvage value cannot fall below, or your book value cannot fall below salvage value. So yes, Erica, you are correct, where you can't produce that. Why? You're restricted by a capacity. Once you go beyond that capacity, that's it. That's it. You can't go beyond it because the potential risk of producing defective items, right? So here, you cannot produce more than your capacity, and your book value cannot exceed or be less than salvage value. So what do you have to do? Like just exactly what you said, we're going to have to make our adjustment here to reflect that our book value should hold salvage value always. Okay? All right? Any questions here?
No.
No.
So this is how they calculate when they give you warranty or something like that.
Exactly correct. Because that's how they estimate, right? They say, well, if you're a customer, you're walking here, how often do you use a computer? Oh, you're going to use it every single day? Well, then if you want a warranty, here you go. And I will give you, and then of course you pay for the warranty. But yes, this is how you yes. Yes, this is where it's derived from.
Gotcha.
Okay, so there you go. All right, any questions there? Okay. So then we're going to spend the next couple minutes to kind of talk about how we would reflect this in our books. How do we record our depreciation? Okay, so straightforward, right? This is an expense to the company, right? What we solved for in our table was, in fact, depreciation expense. Okay, so that's the first thing we're going to journalize is going to be depreciation expense. However, one rule of thumb here is because of Acct telling us that we cannot record our values, or we cannot reflect in our books that we have, when we purchase our assets, it must be at historical cost value. So therefore, we need to create a contra account called accumulated depreciation. Okay? Now, this is a contra account that's going to go to, it's a contra account for your fixed asset. Okay? Now, this is so then when we do sell our machine in the future, we can use the depreciation expense because, again, whatever your asset, it's not going to be worth what you purchased it for. It's going to be significantly less because you used the machine. So that's what this is for. But also, it also comes in hand to hand where if you're creating an expense, where's your equal and opposite credit? Right? So in this case, you need an account to reflect it. And because since we can't directly take it directly off of our asset, right? That's going to be called the direct method. Then we have to create a contra account to reduce it. So then when we look at our books, it's going to hold book value, right? Because you're going to add the main account with the contra account together to reflect what the asset is worth now. Okay, so that's what we're doing. We're going to create a accumulated depreciation account, which is a contra account. Okay. And once again, if you need to solve for year 2, right? We solved for year 2, right? Because year 2, we decided that we used up a total of 2,000 toys, or we produced 2,000 units, right? Which we got a grand total of 2,500. So for this case, right, we're going to always journalize it for whatever we created the depreciation expense for, okay? On the ledger is where you're going to keep track of an account balance of how much you have depreciated over its years. So in this case, right, every time it's during the year and I'm depreciating it, I'm just going to record it exactly like this. Depreciation expense, and I'm going to credit my accumulated depreciation. On my ledger, it's where my accumulated depreciation for every single year is they're going to start adding up together. Okay? So that's how you journalize that. Any questions on journalizing?
So it's always going to be a depreciation expense and accumulated depreciation. Those will be always the account.
Correct.
Okay.
Correct. And this is going to be universal for any type of method you use. So tomorrow we learn double declining. That will be the same exact journal you'll be doing, except obviously the calculations will be different.
Yeah, thank you.
Yes. Okay. The accumulated depreciation, once again, this stems out because of the historical cost principle, and also because of our matching principle, because we need a place to put this depreciation to reflect our book value at the end of its life, or whatever, at the end of its accounting period. Okay. So then now let's talk about partial years for activity based type of depreciation method. Okay, so here I have another example, okay, where my asset, right, I bought another machine, okay, it cost me a total of $10,000. Its salvage value is $2,500. Its useful life is 5 years, and in this case, number of units that it could produce is 25,000 units. And the date that I placed into service was October 18. Okay? Now, because I placed it into service on October 18, when can we actually start depreciating it?
The next month.
Right.
November.
Because in this case, I barely used 50% of it. for that month, right? I used it after the half mark of the month. In fact, I started 3 days after. So in this case, I barely used it for 50% of the month. So I'm going to treat it as if I'm going to depreciate it the next month, which is going to be the month of November and the month of December. Okay? So let's go ahead and put it into context. So if I place it in service on October 18th, how should I fill out my table? So let's go ahead and do this. So for that first 2 months or the first year, right? Let's say, assuming that my accounting period, right, ends on December 31st. So therefore, I only need to depreciate only 2 months, right? Because the depreciation, when we purchase our fixed asset, we're going to treat it like it's our baby, right? So the day that it plays into service is October 18. So therefore, right, if I'm depreciating it the next month, that means it's going to be 1 year if it's the next year on November. But in this case, because I'm depreciating at the end of its year, therefore it is only 2 months old. And within those 2 months, I've produced 250 units. Okay? So in this context, what's going to be my depreciation rate? Or let's do basis first, then rate, then expense. So what is going to be my depreciation basis?
$7,500.
7,500, right? What's going to be my rate?
This is 0.3.
Okay, 0.3. So that means it's going to cost me 30 cents per unit I produced. Okay? So therefore right here, right? So if I calculate it, right, 30 cents times 250 should give me a total of $75. Okay? So that means for the very first year, I used it for 2 whole months, right? I depreciate it for November and December. Therefore, I depreciate it for a total of $75. Now here's the catch. In this case, we don't care how old the asset is. It may last us up to 5 years. It could last us to 7 years because our most important key factor is that this is activity based. It's based on the number of units that I produce. So if I reach my 5th year and I haven't reached 25,000, it can go on to the 6th year, the 7th year, as long as I reach my capacity. Okay, so that's the difference between here is, in this context, right, we still treat it as if it's old, right? We determine it, right? If we're doing it every year, this is how much I produce within those 2 months. But the idea here is that we don't care how old the asset's going to be. We care about the capacity that it can create. Okay? Now that's just only for this one. Okay? When we dive into tomorrow, when we take a look at double declining, yes, we do care of exactly how long the asset is for and how much when you placed into service. Okay? So that's that. And then, of course, once again, you're going to journalize it exactly like this. So in this case, partial years does not matter because the whole point of here is that you're going to be given a number of how many it's being produced that month or that year. So in this case, you don't even really need to calculate anything here. Nothing more here. Okay? You're just looking at what the capacity is. In this case, I only produced 250 units that year. Okay? Any questions in regards to chapter 11.1? Okay. So this is what we talked about, depreciation. Okay. We talked about the 5 components that make up for depreciation, which is your asset cost, the estimated useful life, the salvage value, the date that you place into service, and then once again, what depreciation method you're using. Okay? Once again, when we talked about salvage value, right? And estimated useful life, that's going to be determined based on GAAP. Or if you are a sole proprietor, you can get away with it by determining the amount of the estimated useful life and the salvage value. But for most cases, I'm going to teach you it the GAAP way just because it's just much easier. No calculations, no research needs to be involved. So here, you just need to know that it's already determined for you. Okay? It's determined either as 5 or 7 years, or, and last but not least, you have no residual value at the end of its life. Okay. And here's a fun fact too, in case this is so then, as management, yes, you can go ahead and just use GAAP if it makes it easier for you. If you're like you don't want to do the research, that's fine too. And you can mix and match. So I could say, I have an asset that's worth 5 years, but it has a salvage value. Yes, you can mix and match um, concepts when you are the sole proprietor. And of course, last but we also talked about the date that you place into service. If it falls between the first 15 days, you depreciate that month because you used the machine or the fixed asset for more than 50% of the month. And then again, if it's less than, or in this case, if it falls on the 16th to the 31st, that's less than 50%, so you're going to depreciate it the month after. Okay? Down below is how we journalize our depreciation, and this is the formula. Okay? Right here. Okay? Keep this. It's also part of your review sheets. So instead of having to memorize this, so I will not require you to memorize this, but I do require you to at least have this sheet next to you when you're doing your exercises or completing the exam. Because once again, I'm not going to force you to memorize this stuff, but I am going to kind of hope that you use the resources that you have. So once again, here are the formulas, all right, and the definition of why you would use units of production. Okay. Any questions in regards to chapter 11.1?
This recording is going to be at some point this afternoon in our
Correct.
files, right? For us to review again.
Correct.